What a turbulent week for the market. Earnings and mixed macroeconomic data really brought the volatility, but through it all, stocks prevailed. But what we see on the surface is only that, and diving deeper into everything tells a different story. So we're going to dive into the nitty-gritty and answer why the market just brushed off hotter than expected inflation data. Is this complacency, or is Wall Street distributing liquidity under the hood? Today we're going to answer that question, talk about earnings and the meaning behind this chart. But we also need to discuss regional banks. Republic First just went into receivership, and it will have major implications for the market heading into FOMC next week. Is this the start of the long-awaited commercial real estate crisis? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers. Guys, so we're going to break down the day's trade on Friday as well as the week's trade here all at once, so bear with me. So this is the daily heat map of the S&P 500, and guys, Friday's trade was very mixed, right? Have a look at the mega caps and semiconductors. So the biggest names in the S&P 500 rallied. The second you have that, you're just going to get complete outperformance regardless of what the rest of the market does. Google, Amazon, Microsoft, Nvidia, semis as a whole all participated, as well as names that were upbeat on earnings. Look at Chipotle, GS, PayPal, right, GEV, ETN, GE as a whole, Eli Lilly, Costco. So the reason why stocks rallied on Friday had to do with the earnings picture, but there was a lot of red, and that had to do with the macro picture, and that was behind the GDP data and the PCE data. And if we actually pull up something like this, Friday's trade, look at the Nasdaq up 1.61%, the S&P 500 up a full percentage point, same with the IWM. But then we have a look at something like the RSP up 0.05% for the day, and this definitely goes to show that despite the upbeat action we saw here in the indices, on Friday the trade was still very mixed, and the market actually didn't really like what they saw with the GDP figures, with the PCE figures. Zooming out, looking at the week as a whole, a very upbeat week. Every sector gained, a lot of stocks gained a lot. Look at Nvidia, Google, Apple, Microsoft. Look at Tesla, right, up 14% for the week. Earnings can change everything, and if we actually look at the best performing sector this week, semiconductors, and then in not even a close second, technology, followed by discretionary software. So the mega caps doing really well, but you go all the way down the tape, the worst performing sector is XME, barely negative for the week. XLB up 0.63% for the week. So every sector gained this week. It was a very upbeat week. And then we actually have a look at the indices, right? I mean, the worst performing index was the Dow Jones up 0.67%. The Nasdaq was up a full 4 percentage points in the week. The IWM and S&P 500 up 2.7% here. So a very upbeat week, but a lot of indecision on Friday's trade based on that GDP news, based on that PCE news. That is going to bring a lot of volatility next week. But let's actually hop on the charts and talk about what we saw on Friday and what we expect next week. Now guys, we're going to break down the S&P 500 here on the monthly, weekly, and daily time frames. Now we've been using this chart all week. If we just hop to the daily chart, you can see that this has been the line that we've been looking at for the last 2 weeks. Ever since we started this pullback, we said we really wanted to enter longs anywhere from the 49.20 to 5,000 level, and it has actually offered a very good line of support, and we have since actually rallied all the way just above the 5,000, very close to the 5,100 area. Now we're just actually going to remove all of these drawings right here and then skip to the monthly chart just to clean up the chart. Now looking at the monthly chart, I know the month is not over, and we will go in depth on Wednesday into the monthly chart once the monthly candle closes, but we can definitely see that we have pared a lot of the month's losses in this past week. We are still on a red bodied candle, and it does look like we are going to finish the month on a red candle. However, we are back to last month's open, where we opened March, and while we are a while away from the all-time highs or the close of March, pretty much April's open, you can definitely see that the price action has definitely been constructive here on a monthly chart, at least if you look at it like this. And at the end of the day, we've had 5 consecutive green months. A red month was all but due. Now let's hop on the weekly chart, and we can actually see a lot more glaring things. Now zooming out, we do have to understand that we are in the the context of an uptrend. Okay, you can see that we've made higher lows all the way to where we are right now, and we've made higher highs along the way, especially new all-time highs, and that is bullish. Now on a weekly chart, guys, we say this almost every single week, that until we actually get to around about this point right here, that is when we really want to start becoming concerned about potentially breaking down to these lower levels right here in the S&P 500. But until we actually get to around the 4780, maybe even the 4800, I wouldn't be too concerned with the index going lower. I would just look to buy dips into this pullback. The reason why this is such an important level is actually because this is the previous all-time high year in 2021, and we do know that resistance turns to support, and then we actually sprung off this area. So if we do go lower, you do have to understand that while that may be bearish on a day-to-day basis, in the context of the weekly chart, we are actually still bullish, and this pullback we're actually seeing here in April is completely normal. Now, zooming in, looking at the most recent weekly candle, we can definitely see that we put a low right here, we gapped up, and we've actually closed in the top 10% of the green candle. However, we still are a while away from last week's open as well as last week's high, but price action is looking constructive for us to go ahead and take these levels and even potentially hit new all-time highs into May. But there's a couple of obstacles that the S&P 500 needs to go achieve. Now, looking at the daily chart, let's actually eye out some very key levels. So this right here, we're going to actually make this green, right? That is the weekly support level. Now, very key levels we're going to stick to is the exact same level we've been looking at all week. It's this 4920 to 5000 level right here. Okay, this is a very key zone, and we don't want to lose sight of the fact that we did find support in a very critical zone. We do know that 5000 is a psychological number, but there was also a ton of weak structure right here that we actually repaired by us moving down into these areas right here. I mean, look at these wicks, right? Very weak structure as well as a gap. We repaired all of that technical damage, and now we're moving higher. Now there's a couple of things that we need to do. Zooming in some more, okay? Looking into next week, there is a lot of things that could bring the volatility. A very key support zone that we need to hold is this 5000 level, but I would say to be more constructive, the real level that markets want to hold, especially the S&P 500, is actually this level right here, the 50-20 level. If we actually pull back to this level right here and then move higher, that's going to be very constructive, because then we would have put in a low right here, a higher low, and then another higher low right here. And that means if we go put in another higher high, that would be continuation of the uptrend. Now, I would just prefer it if we just rally and go and take this level right here, break above, use as support, and then continue the rally. And essentially, that's what the markets need to do this upcoming week. I do think with the major volatility we're going to see, this level right here, 4150, is the major zone that markets need to go recapture and close above next week. Problems will reside for the bears the second we get below this 50-20 level, because that means the bears pushed to this line of support right here and then actually pushed below. And if bulls don't find support at this level, right, we could definitely see downward momentum, and then making a lower low relative to this wick right here will actually embolden the bears to push us lower, potentially to as low as 49.20. However, you do have to understand that this continues to be the buy zone, and we do want to buy in this area even if we do go make lower lows. And until the 49.20 area is broken with conviction by the bears, I remain constructively bullish. In this area right here, 50.20 to 51.50, I remain bullish. And a close above definitely opens up some of these levels right here and potentially new all-time highs. But I think for all of this price action to materialize higher, we do have to see participation by the broader market, the RSP, and it hasn't quite been as strong as the SPX, purely because the mega caps have really outperformed this week. They've really shown their strength. And what we really do want to see is the RSP not break below this 159 line right here. If it does trade lower, we want to see support happen here and then a move higher. But ideally, what we do want to see is just strength in the RSP. If we get that, expect the S&P 500 to outperform, expect the Nasdaq to outperform. I think a big thing you want to watch this week is actually yields. We do have QRA there's going to be a lot of volatility in rates. And the second we get volatility in rates, that's greatly going to affect bonds. And when bonds move, stocks move. You see, stocks don't determine how bonds move. Bonds determine how stocks move. At the same time, something you guys also need to watch this week, guys, is gold. I want you guys to look at gold, particularly during the FOMC and what happens with regional banks. And another thing I want you to watch is the dollar. The yen and the dollar trade is starting to unwind. Things are getting a bit risky right there. I'm going to dive into it, a video during the week, but watch the dollar. If it continues to show the strength that it has, that is certainly going to pose problems for the Fed. You definitely don't want to see the dollar at these levels. What you really want to see is the dollar move lower, closer to this 100 area. That's really what the Fed wants. So a lot of risk next week. A lot is going to be dependent on the macro and the fundamental, not so much the technical. So I would look at the economic data. I would look at what Fed speakers have to say. I would listen to the FOMC. I would listen to Yellen, and I would look at yields, focus on the macro, focus on the fundamental, and pay attention to earnings, particularly some of the big mega caps next week, the big healthcare names next week. That is what I would look at for your signal to buy or to sell. That being said, you know where the levels are. Inside this zone right here, we are bullish to 51.50. Below 51.20, we want to buy dips all the way to 49.20. If we do get below 49.20, I'll give you guys an update in the week. So go subscribe in case we do get a serious move down, and I'll keep you updated with the latest. Looking at the AA sentiment survey, guys, where do AA members feel the stock market will be in the next 6 months? And things are looking fairly neutral. Despite the 5% pullback here in the S&P 500 we've had in the last 2 to 3 weeks, sentiment is not bearish, sentiment is not bullish. I would say that it's fairly split. And these figures right here are the historical averages going back to as far as this survey has been out. You could actually see that we've become incrementally less bullish in the last few weeks as we have pulled back. And this actually just signals a healthy market. If we do start to see these neutral votes get bearish, these bullish votes go to neutral, that's when we can really start becoming maybe risk off. But, despite the pullback and the little bit of a relief rally we've seen in the last week, things are not bearish, things are not bullish. It's actually a fairly healthy market environment. Now, looking at some seasonal stats right here, this is the S&P 500 after we have a first negative month following a turn of the year hat trick. Now, the turn of the year hat trick is when we have a positive January, December, and February, and then we have our first negative month. Now, April is not done. There's still a couple of days, and don't get me wrong, we can 100% rally to new all-time highs and have a positive April before the end of the month, which is Tuesday or Wednesday, depending on where you are in the world. That being said, assuming we get a negative April, these are the forward returns in the next 1 month, 3 months, 6 months, and then the max drawdown. And you can see here that normally the next month actually tends to be positive, up 2.54%, 21 wins, 4 losses. The same is true for 3 months later, 20 wins, 5 losses, 4.1% average return. And then 6 months later, 22 wins, 3 losses. So it gets incrementally bullish, 8.58% return. So essentially, this 5% pullback we've had in the market, that should just be looked at as a buying opportunity, because normally the stats suggest that 3 months, 6 months, 1 month later, we will be higher. And I don't see why it would be any different. Now, here's the crazy thing, right? Look at some of these max drawdowns. You can't see any negative figures. So in other words, once we have this negative month, we go positive from the get-go and then onward and upward from there. Now, this does give us a pretty good picture as to what to expect in the S&P 500, but what about an election year? Because election years tend to bring the volatility. Seasonally speaking, May to October tends to be fairly negative, at least on a seasonal basis. However, it is different in an election year. May to October in the S&P 500 normally returns 2.3%, 78% of the time higher. So very, very positive stats right here. And this just reinforces the fact that in April, pullback we've had, we should really be looking to buy the dip, because the stats are definitely on the side of the bulls. And you can have all the bullish stats in the world, but ultimately what drives price action is earnings. We have another big week of earnings, and we kick it off on Monday with stuff like SoFi, onsemi, Domino's Pizza, NXPI, Paramount. But it really gets going here on Tuesday. We have PayPal. We're going to really dive into depth with PayPal. We have Eli Lilly, 3M, McDonald's, Coca-Cola, some very, very big names. We also have, after the close, Amazon, AMD, SMCI, Starbucks, Riot, Pinterest. Then Wednesday, we have quite a number of healthcare names, Pfizer, CVS Health. We also have Wingstop, Kraft Heinz. And then after the close, nothing really in terms of name value, but there's like Paycom, Carvana, Qualcomm. Then Thursday, we get Novo. That's probably the only big one in the morning, Moderna as well. And then after the close is the big one here, Apple, Coinbase, Block2, DraftKings, Cloudflare, Bill.com, Fortinet. That's part of the undervalued portfolio. You know we're going to look at that. And Bookings Holdings, that's actually a stock I'll be looking at as well. And then Friday, the dividend investors with Hershey, Fubo TV, and a couple of other names that's really good there. So a big week of earnings, guys. Now let's actually have a look at the earnings scorecard now. We're doing really good for earnings. So this is the start of earnings season. So on the 1st of April, this is essentially what the market was pricing in. What were the expectations? So 3.5% revenue growth, 3.5% earnings growth. Right now, we're sitting at 3.8% revenue growth, 5.6% earnings growth, excluding energy, 8.5%. And if you include energy but exclude this BMY adjustment, you're looking at 8.7% earnings growth in the S&P 500. So we are absolutely smashing earnings right now, doing really, really well. And the best performing sectors here are comm services on the earnings side, tech, and then utilities, discretionary in a close fourth place right behind utilities. So a very, very good earnings season so far, guys. And we've had a lot of companies report already, 229 out of 500. So there's actually a good pool of data. And, you know, let's say Apple surprises to the upside and Nvidia comes in line, you could actually see these numbers materially move to the upside. And that's actually going to affect the BMY adjusted figure as well. So we've had a great earnings season, but where does that leave us with valuation? Because price is what you pay, value is what you get. And right now, the S&P 500 is sitting at a 20.1 times PE forward ratio, a 3x EV to sales, a 3.4% free cash flow yield, and a 1.3 PEG. We could see that the most expensive sectors continue to be infotech, discretionary, and industrials, with the cheaper sectors still being energy, right? Then financials, and then real estate right there. Middle of the road sectors that I really like, I say this almost every single week, but nothing has changed. I do like comm services and healthcare for growth at a reasonable price. Look at the PEG ratios right here and look at the free cash flow yield. So you're getting growth, but you're not getting anything that's too expensive. And we're also trading below the market average PE, 18.1, 18.6. And you get great names in these sectors right here. But if you're looking for absolute growth, you probably want to look at stuff like infotech, consumer discretionary. They are priced for growth, and that's why you see these huge valuation PEs into these stocks. But all in all, guys, I don't think the S&P 500 right now is actually expensive. I think with how high quality the S&P 500 is, it's perfectly fine paying 20 times. You know, like 36% of S&P 500 companies are 60% gross margin or higher. That is definitely worth a 20 PE or more at least. And if you're a very long-term investor, you want to look at the S&P 500 and look at it as a buy right now. And if we do go lower, you want to keep adding to those S&P 500 longs. Now, let's actually talk about the economy, guys, because earlier this week, we got two major points of economic data that we really need to speak about. We got GDP at 1.6%. It came in a bit soft. And we got PCE at 2.8%, came in hotter than expected. And the market saw this as potentially, you know, we could be looking at a stagflationary environment. However, GDP now figure has just come out. This is part of the reason why the market passed the current GDP print and the PCE print, because the Fed GDP now actually printed just under 4%. This right here is 3.9%. So, you know, maybe the market is saying, hey, a lot of the government spending is going to materialize in this quarter right here, and we're going to have a higher than expected GDP print that's maybe going to make up for the 1.6% print. And essentially what the GDP numbers are telling us and what the PCE numbers are telling us is that, you know, the economy is chugging along fairly well. 1.6% is growth, but what the PCE numbers are telling us is that the consumer is fairly robust. Even though PCE is an inflation figure, it's personal consumption expenditure. It's essentially what consumers are spending their money on. And we could actually see this in the rail traffic data. We got the latest data right here for the end of April. You could see this week, 8.2% increase year over year. And on a year-to-date basis, 9.1% year over year versus 2023. And then total traffic, so that was intermodal units. Total traffic right here, 0.8% versus 2023 and up 2.3%. And for those of you that don't know, rail traffic generally tracks GDP very, very well. It's a great parameter for what GDP might do. And this is telling us that, you know, the consumer is strong, the economy is strong, and we also got consumer sentiment. This chart doesn't really tell us much. Consumer sentiment came in at 77.2. The market was expecting 77.9. So it came in slightly below, but I think inconsequential. What we really have to look at is the commentary here from Joanne Su, who runs the University of Michigan Consumer Sentiment. And she wrote, consumer sentiment continued to plateau and was virtually unchanged for the third month in a row. Since January, sentiment remained remarkably stable within a very narrow 2.5 index point range, under the 4.8% necessary to be statistically significant. The long-run business outlook inched up to reach its highest reading since June 21. While views of personal finance softened, different parts of the population exhibited offsetting changes. Younger consumers, their sentiment rose. Middle-aged and older adults, their sentiments was little changed or fell. Overall, consumers expressed uncertainty about the future trajectory of the economy pending outcomes of the upcoming election, but there was no evidence that the geopolitical factors are at the forefront of consumers' minds. Inflation expectations ticked up from 2.9% last month to 3.2% this month. So definitely some inflation concerns right there, but the consumer remaining largely robust, and that's why, sentiment just ticked down a hair and we didn't see an implosion despite the PCE and GDP print that we got this week. Now, let's actually talk a bit about PCE because it came in hot. There's no way to put it, right? PCE came in at 2.8%, consensus was 2.6. Headline PCE came in at 2.7, consensus was 2.6, but the month-over-month figures both came in at 0.3, which was in line. So now this begs the question, why did we get a hot number if the month-over-month figures came in line and it actually had to do with revisions? The February period got revised upward, and that meant that the base effects of PCE lifted the overall inflation rate. But the market didn't react adversely. In fact, we gained significantly on Friday's trade, and that was largely led by mega caps as well as the GDP now figures in the market just looking past these PCE figures as a whole. At the same time, you could also see the personal income came in line and personal spending actually beat, and that's why PCE came in hot. But this is showing us that despite inflation coming in a bit hot, the consumer is robust, and this is why the market sort of ignored these figures. Imagine if PCE came in hot and this missed, and then personal income missed. That would signal, okay, stagflation is here, because this is just a weakening of the labor market as a whole. Another reason as to why the market just looked past these figures right here is because headline PCE came in at 2.7%, and on a 12-month annualized basis, inflation is decelerating, and we actually haven't seen an increase on a year-over-year basis. So last month we printed 2.7, we were expecting 2.6 this month, we printed 2.7. So inflation on a 12-month annualized basis, guys, isn't actually increasing, but on a 3-month annualized basis, inflation surged to 4.4%. So inflation is ticking up, and this is concerning. You can't deny the fact that inflation is accelerating, but it should improve over the next couple of months because base effects of core PCE here in June, July, and August are very, very favorable. Whereas right now they are favorable, but the base effects aren't as low as this period right here. So in absolute terms, inflation will come down in 2024, especially after this June, July, August period. Problem is, and the question is, how much is already priced in, and what does this mean for the rate cut picture? And to help us answer those questions, we have some BOFA commentary. So they say, no sign of stagflation. Another firm inflation print, headline and core PCE inflation came in both at 0.32% month over month for March. We forecasted a 0.25% increase, but were braced for an upside surprise after the large beat in yesterday's Q1 inflation data. Core goods prices was up 0.1%, while core services printed 0.4%. So services continues to be that sticky part of inflation. Year over year, core inflation remained flat at 2.8%. Bad, but not terrible. The question going into today's release was how much of the beat in quarterly inflation would be reflected in revisions rather than the March data. Revisions ended up playing a big role. The core PCE was revised up 5 basis points for January, while February was little changed. Given the math of quarterly averaging, this mitigated the impact on the year-over-year rate. Spending continues to surge. We looked at that. Further declines in the savings rate. This is what's really important. This is what I want to look at, right? Yesterday's GDP release showed a miss on GDP growth, 1.6% versus 2.5% expected, and a beat on PCE inflation. This created the narrative of stagflation or a negative supply shock, We think that this view is misguided as it's based on apples to oranges comparisons. The miss in GDP was driven by trade and inventories. Consumer spending, which is related to PCE inflation, remains resilient. We instead see the Q1 2024 data as consistent with acceleration in demand, particularly for services. One explanation is that demand has risen as a knock-on effect of the income generated by the ongoing positive labor supply shock due to strong immigration and labor force participation. So all in all, we're seeing a demand-driven economy, and generally speaking, that's so much better than a supply-driven economy because a supply shock is a lot harder to deal with than a demand shock. All in all, Buffett don't really see any signs of stagflation just yet, but if this data is to persist, weaker growth, right, higher inflation, then they will have to change their tune. But long story short, as long as inflation is driven by demand and a strong consumer, I guess it's okay, but we'll see how long this can last. Now, data in the week ahead, guys. So next week is a very big week. Along with earnings, we get the FOMC rate decision, non-farm payrolls, ISM manufacturing, and services. So very big week. Here on Wednesday, we're going to get the FOMC decision. We also get the JOLTS data, ISM manufacturing data, a bunch of employment data, ADP, initial jobless claims as well, and then non-farms at the end of the week. So a very, very big week of data, a very big week of earnings. So be prepared for volatility. Something else that's going to bring the volatility is that on Friday after the close, regulators actually went to go seize Republic First Bank. It was a $6 billion regional bank that had the same problems as some of the ones that failed in 2023. And we do know why this happened. The BTFP, the Bank Term Funding Program, closed. This bank probably had liquidity issues, capital flight ensued, the bank couldn't meet its short-term responsibilities, and now we have this situation. And with FOMC this week, I'd love to hear power statements regarding this and what the Fed's going to do. Are they going to set up some form of liquidity program like the BTFP for maybe these smaller banks? Is a bigger bank going to acquire this bank? What's going to happen? I really want to know. This is going to be a big story going into next weekend. Without a doubt, this just proves to us that there's definitely some stress in the financial sector still ongoing. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.